Thank you so much, Srinivas, for joining us and taking the time to speak with us today.
Thanks, Kaustubh. Thanks for the introduction and kind words. I will just give a quick introduction about what we do at RuleZero, and then we can just a minute or two. What is relevant for this audience is that we have a very sophisticated cap table management system. Cap tables tend to get very, very complicated as as the company grows. Sometimes it's complex at an early stage as well. When you want to issue shares to advisors, you have some structures in place for co-founders, structures in place for incubators and accelerators, asking for all kinds of instruments. So the moment there is any form of complexity, RuleZero platform becomes extremely powerful and ensures efficiency in fundraising and accuracy. Even when there's no complexity, there's some things which tends to get complicated because of compliance reasons, and lots of errors are made, and cap table errors are, unfortunately not very forgiving. Therefore, important to manage your cap tables well. The second thing that we do is ESOP management in all shapes and forms. ESOP is becoming a very, very important and powerful tool from an employee engagement perspective, from an employee retention perspective. So we work with a bunch of startups to help manage their ESOP pools, ESOP design, ESOP plan constructs, managing grants, structuring grants, etc. That's a very, very quick introduction about RuleZero. We can dive straight into the topic today. What I'd like to highlight today more is, not talk too much about specifics of fundraising, but look at how fundraising in the deep tech world is a little different from fundraising in the the regular ecosystem. Consumer applications, consumer companies, fintech companies. There are lots of elements which are common. I will not delve too much on them. The focus will be more on why deep tech fundraising is a little different, and how you need to look at fundraising in the deep tech world. The first question really is, how are deep tech startups different, right? Deep tech startups can either be in the research phase where you're completely groundbreaking, path-breaking research around around various modules of technology, or you could be building other foundational technologies. Unlike a consumer or a fintech enterprise where the market segment, the product clarity, there is no product clarity or market segmentation, etc. In a deep tech startup, deep tech startups tend to be focused more on the technology itself that they're going to develop. There is a rough idea around what are the markets and what are the products you'll build, but it's very rough at that stage, and therefore it's some of the detail which a consumer-facing company will have will not be there in a deep tech startup. There's a lot of technologies which are intersecting, and lots of integrations possible. You use a lot of other technologies to build your own product to. The customer acquisition process is very, very different. It takes a very long time to win customers in this space. Need to really understand how customers function, where in their life you fit in, and how do you make that fit work well from a customer perspective. Those things are very, very different in a deep tech startup. Validation cycles are much longer, simply because of the nature of the product. And also because it's deep tech and it's still either foundational or very, very deep, research involved, very hard to pivot. A consumer company or a fintech company usually gets a lot of market validation as you're building the product out. And because you have the market validation, customer feedback, it's possible to pivot. Whereas in this space, it's very, very difficult to pivot simply because, one, the nature of what you're up to, and second, there are no customers at an very early stage. Prototyping is obviously much more much more expensive and takes a lot of time. And diligence from investors is complicated. Team building is a little more difficult. I'll come to that a little later, but the one key difference here between deep tech startups and other startups is that other startups tend to have one business founder and one tech founder, at least. Whereas a deep tech company will usually only have tech founders. Rarely do you see business people being involved in a deep tech company at an early stage. It's really about research and development very early on. So both founders need to be, deeply focused on the technology itself that is being developed. Later, of course, usually one of the co-founders takes on a more business role as well. Hard to get people even at a later stage who understand your technology, your domain, the problems you're solving at a deep level. Therefore, the two co-founders tend to, one of the two co-founders tends to take on a more business role as well at a later stage. Three broad questions, right? When you're, when you're looking to raise money, when you read is fairly simple. It is no different from other startups. But what capital to raise? One source which is available to deep tech startup, which is usually not available to other companies, grant capital. We'll talk a little more about grant capital versus equity a little later. But grants are a very, very viable option at an early stage. And whom to raise from? The investors who invest in the mainstream. I just use the word mainstream, just for ease. Not that what deep tech companies do is not mainstream in any sense. This is equally mainstream, but just that I'll use mainstream to more to say this is the more common industry that you see. It's the consumer-facing companies, fintechs, etc., which are raising money much more often, and you'll see much more volumes of capital going there, many more deals, many more companies. So I'll just use mainstream only for convenience. Please don't use that. Please don't look at it as or I'll say deep tech and non-deep tech. That's easier, so there's no confusion. So there are specialized investors who invest in deep tech companies. We'll talk about that a little later as well. So how do VCs evaluate deep tech startups? Kaustubh, at the one side on this slide would be great to have your feedback as well, especially how you guys look at it and how Social Alpha looks at it. But at the beginning, the founder's experience matters a lot here, simply because of the long gestation and the deep understanding that the team needs to be able to build any business here. So investors tend to look at the background of the founders a lot more, and relevant experience in this space. Hard for people without experience to build very easily from here. The second thing you'll find very, very commonly in deep tech startups is the role of advisors. Deep tech startups tend to have a lot of advisors, especially from academia, to support them. The early tech team is equally important. It's very, very hard to build a team in this space, like I mentioned earlier. The team needs to understand what you're building. There's not much money. The interest in research needs to be there. Interest in focusing on solving big, deep, complex problems needs to be there. In the non-deep tech startups, a lot of application is involved here. It's very, very foundational. Therefore, harder to find a team. The market analysis, VCs tend to look at this space as global. It's not only an India or a US market that investors look at. It's always a understanding of how deep can you go globally. Customers here will look at, they don't care where the technology is coming from, whether it's US, India, China, or Europe, doesn't really matter at all. So the product also needs to be global because customers are scouting for these kind of technologies globally. The adjacent markets need to be large as well. Given the nature of this space, you don't even know who all are building on something like this. Competition comes out much later. The knowledge of the competition comes out much later. So therefore, the adjacencies need to be important. a common term which the VCs use when you say technology, how deep, how many E's are there in the deep? If it's just two E's, it's not deep. There need to be a lot more than two E's. This is a term that a lot of VCs like to use. Very, very important that it's not just some basic applications. And it's important that there's not much knowledge or understanding of the specific problem that you're solving. AI, for instance, 15 years ago would have been only deep tech, whereas today AI can be sitting anywhere. Any company which is not using AI doesn't is not really a VC fundable company, right? So robotics today is probably a lot of it is still deep tech. There are some consumer companies, but largely it's still deep tech. So it's really about how deep is the technology, and where you're building it and all this. A lot of maturity, the maturity stage at a global level is important for a deep tech startup. Again, if it's a very mature industry, you can't really call it a deep tech company. But again, just to take a random example, any battery management system in an EV startup is not really deep tech. But if you're very focused on how the cells function, how much more quickly can you charge a battery, for instance. It takes 1 hour. I just take a random example here. It takes 1 hour to charge a battery, but if you can find a way to make it 10 minutes because of sorry, just give me a second. Sorry about that. If you can find a way with better technology infrastructure and better application of technology to charge a battery in 10 minutes, now that becomes deep tech. So in some areas it's entirely deep tech. Some areas are wherever research and development has been going on for the last 10, 20, 30 years, it sits somewhere in between the two. The third thing is the value of intellectual property itself. In a non-deep tech company, largely there's a lot of publicly owned technology, open source stuff which is used. Whereas in a deep tech company, patents become important. How many patents can you get? How much research have you done on what kind of patents already exist? Where in that patent ecosystem will you sit? Those things become super important in a deep tech company. As far as potential customers are concerned, the only thing you'll really know is buying behavior and process of a customer, and the roadmaps that those customers have, and where in that roadmap will you sit. Now, if just a random example again, if what a customer needs in the next 6 months is what you're developing, but it takes 2 years to develop, it really doesn't it doesn't matter, right? I mean, you already lost the plot. You need to be in the customer's roadmap, consistent with your own development cycle, possibly a few months ahead of when a customer would start looking at deploying these things, is when you need to be ready as a company to be ready to deploy, and you need to work backwards from that to determine your own schedules in development and stuff like that. Next slide. Kaustubh, would be great. Sorry, just go back to the previous slide. Kaustubh, would be great to get your feedback as well on this slide.
Yeah, I completely agree with you, Srinivas. I'm going to keep it really short because I'm sure people want to hear more from you. I think a couple of things that you raised are extremely on point with what we also look at, given that when we're looking at extremely early stage companies that are still in the product development stage of their journey, I think seeing how deep the technology is and what is the value of the IP, I think that becomes extremely critical. And like you said, how patentable is your solution and how it is going to be solving a problem for the customer. And I think I agree with you that we're not able to maybe see direct examples and applications of those solutions right in the instance, but maybe 6 months or 1 year later. So there are proxies that you can take in the market to analyze what the size of the business could actually be, even though you may not have the exact same product right now in the market. And I think for us also, what becomes most critical, and what you alluded to right at the beginning of this discussion, was how important the team is, given that the team would largely be a tech-focused team at this stage because they're developing that solution. I think to see whether or not they have that acumen to understand what the market needs and design for the market rather than just design a solution in a lab. I think that also becomes extremely important, and how they'll be able to actually execute on it when the time comes. So yeah, completely resonate with the kind of things that you mentioned, Srinivas.
Awesome. Thanks, Kaustubh. So can we just move to the next slide? So, this is a, I don't want to delve too much on this because this is something which all of you will have a fair understanding of. But, in phase 4, 5, and 6 is actually the best time to, look at external money. In phase 1, which is research, which is really, it's more for grants. Very difficult to find investors who will, invest money at the research phase. The external equity sort of financing is really at the stage when your technology is being validated in the lab. There is technology validation in the relevant environment, whatever that environment is, which is relevant to your industry, and it is capable of being deployed in the environment directly. That is the phase at which VCs would be, VCs or external investment of any form would sort of be available. So, this technology readiness level is very crucial for you to understand. But like I said, this is something all of you understand very well. So I'm just a very, very brief headline structure here. What each of these phases means is something all of you understand very, very well. So, the middle phase is where you can look at external financing realistically. So, the typical characteristics of a deep tech investor, the early investors, is check sizes are usually smaller, and that usually works simply because, unlike a non-deep tech startup, which is looking at a lot of, funds towards marketing, sales, finance, legal, and a lot of other complexity. At the early stage of a deep tech company, it's really only team cost, maybe some in-licensing of some technology, but office space to sit out of. So the check sizes tend to be very, very small in the early stage, anywhere from 100K to 2 million. Global companies, of course, global VCs can write larger checks, but early stage checks are usually in this range. The investment philosophies for the investors is usually very thematic and sector driven. Just to give a random example, in the non-deep tech space, if 3 global VCs sign checks for a particular area, just for again a random example, sometime in early 2010s, if ride sharing started raising money, you'll find 30 investors putting money behind that space and 200 startups getting funded in that space. That usually doesn't happen in the deep tech space. Investors have a pretty deep understanding of the space they're operating in. Their knowledge is usually more sophisticated, and therefore, it is rarely opportunistic. So the conversations tend to be a little more structured with the investors also. And the stage is usually early, pre-series A, seed, series A type checks that you get from investors. Once you get past that stage, you're back to mainstream investors again. So the way a series B check will be evaluated will not be different from the non-deep tech space. Again, there will be notable exceptions there, where something fundamental and groundbreaking is happening, and larger checks will come in even before you have any proof of concept as well. But those are really exceptions. Next slide. We've just made a list of what do deep tech investors look for? Like I said, partner profile. This slide is about what you look for in a deep tech investor. You look at finding customers a little more complicated, right? Therefore, the network that the investor brings is super important. Obviously, when non-deep tech investors do it, But a deep tech investor would do this much more. They help you much more in getting intros done, getting you inside the room for discussions for customers. So it's very important to talk to other investee companies that a deep tech startup has, a deep tech fund is looking to invest into. The other companies will be able to guide you on what sort of help you will get from the investor. Again, given the number of investments, this is not very common, so you'll need to make that effort to find the other founders and talk to them. They will help you understand whether this is the right VC for you or not. The other thing to look for is the ability to write the next check as well. This is sort of important even in the non-deep tech space, but given that you will not have 4, 5, 6 investors on your cap table early on, the one VC that you get, very important to understand whether they'll write the next check or not. If they're not able to support you with some form of bridge or participate in follow-on rounds, becomes difficult for other investors to come in. Therefore, the ability to write next checks, becomes important when you're looking at a VC to raise funds. The investor also needs to understand that given the nature of the development that is going on, the market cycles are much longer. You don't want an investor who will come and ask you for MIS 6 months after they've raised money. You want the VC you want the investor to ask you about tech development, what are the challenges you're facing and stuff like that, and not really an MIS. The moment an early VC is looking at MIS, it really shows that this space is not really for them. So a few of the deep tech VCs who we've seen and are active in India, these are the names. We've seen them invest quite often in this space. So, and it's not an exhaustive list. There could be more, but these are just names that we've seen. So, earlier we spoke about grants versus capital. The key difference in the case of grant is just a grant. It's just money coming in because you're doing something groundbreaking. Grants consequently are non-dilutive. They're not repayable at all because it's a grant. The way you use the money is very restrictive. They tell you what you can use the money for and what you can't. And it's obviously very prestigious to get a grant because there's not too much grant money going around. And if a good donor organization is giving you a grant, it's great. The space is obviously very competitive again because there's not too much money available. Because it's limited, it tends to be a lot more competitive. But again, the number of companies playing out here are not as much. So grants are definitely a great option at a very early stage. Capital tends to be larger checks. Can be, like I said, before you go to non-deep tech mainstream investors, it can be anywhere from 100K to 2, 3, 4 million. There's obviously dilution because you need to issue shares. And there's value beyond capital. Grants usually come with just money and nothing more, whereas capital gets you some network. And because you've raised money, you need to provide an exit at some point. Exit obligations are contractual and more soft. It's not really, one can't say you're in breach because you've not provided an exit. There's a lot more credibility to grant capital, the equity capital coming from VCs and the nature of VCs. Grants tend to be a shorter life cycle in terms of the time it takes to get a grant. VCs evaluate you for much longer before they write a check. So equity capital tends to take more time. So you need to factor this, in your life cycle when you're trying to raise money. When you look at the fundraising stages, we've just sort of tried to break up the 3, 4 stages which are there when you're trying to raise money, and the kind of capital that is available. At the research and development stage, it's really mostly grants, whether it's government or UGC, deep tech incubators, CSR funds, which technically qualify. Grant, certain kinds of grants will qualify for usage by, for deployment by CSR funds. And angels will really be, your own personal network at this stage. Angels usually don't go around signing a lot of checks where they don't know people. In the non-deep tech space, angels tend to be happy to sign checks for people, whom they don't really know well, etc. But at this stage, it tends to be more people you know well. Once you have the proof of concept, which is, your MVP is done, product testing is done, and you're pretty close to the final version, in that space, grants are available, but tend to be, uh, little less common. The angels and angel networks will get active at this space. You have a lot of accelerators as well, and seed funds. The VCs, which we spoke about, will start putting money here. And once you start commercializing, when you're trying to prove your GTM, you do your initial product, your pilots, and you're ready to launch with customers. That's typically your Series A round, and a whole bunch of VC funds will come into play here. The VC funds also tend to do seed rounds globally, and there's another category of seed funds which are slightly smaller funds. And once you get to scale, it's really apart from the VCs, there are also a lot of growth funds which will come into play here. Private equity investors, strategic investors, etc. This chart is more to give you a sense of the kind of investor, kind of money to look for at this stage. Kaustubh, I'm sure you'll have some inputs on this slide as well. So it'll be great if you could chime in.
Yeah. So Srinivas, I think what I completely resonate with what you said, that, when you look at these, I'm going to say partners in your business, because these funds are not just writing checks, they are really guiding the founders. And that's what we also try and do at Social Alpha. And, this entire mapping of the kind of investors at different stages. Sometimes we've also seen players play across stages. I'll just give you an example of one of our startups as well, Voxel Grids. We started engaging with them in our entrepreneurship in residence program in 2016. They incorporated in 2017. They're a Deeptech medical device startup, and they incorporated in 2017. And over the next 4 years, we helped them mobilize a few millions in grant capital. Like you said, at that stage, they were doing R&D and prototyping and just designing the product. And once they started commercializing and had run some pilots, we were able to help them raise from Zoho in 2021, a Series A 5 million round. So I think I completely understand where you're coming from, and it is very, very important to sort of understand what stage you're at, and sometimes see what sort of capital you need to access at that stage. And maybe sometimes you'll find a partner that can help you across stages, and that's ideal.
Yeah, so the Zoho investment is possibly more an exception than a rule, right, Kaustubh? I mean, there will obviously be a lot of exceptions going forward as well, but more important to understand where the rule applies. And obviously, if you have access to an exception, you should go for it. There are always going to be situations where there are exceptions. So don't close your eyes to an exception, but be cognizant of where the rule is.
No, absolutely. Yeah. But we're hoping for more such exceptions to come our way.
Absolutely.
Yeah.
All of us do, right? All of us in this space are hoping to be the outliers, hoping to be able to, make that exception work for
Absolutely.
us. So, sorry, just one thing on the previous slide, just go back to the previous slide. See, as VCs are evaluating you, it's, in a non-deep tech startup, a lot of the technology evaluation is done by the VC itself. They don't use external providers to understand the technology. Whereas in deep tech, unlikely that a VC will have the ability to evaluate your tech. They will almost always use external providers to do the evaluation. So, I would recommend that you actually sign NDAs with the service provider directly. Before you share any information, also get an understanding of, which are the companies they are working with, whatever. You don't want to disclose a lot of your algorithms and how they function and, the thought process. to service providers. The market is not exactly very, it's not always honest, if I can use that term. So being careful is definitely something you should consider. Be careful about how much information you share also. Don't share more than what you need to do, and make sure that you sign NDAs. What should you be doing next? Due diligence preparedness, that's fairly straightforward, in your space, given that it's not so much about a business evaluation and stuff like that. So, basic legal compliance on due diligence. And also, if there are patents, of course, then it becomes, much more intricate. Get a good firm of advisors to help you on your patent strategy, your patent applications, etc. You should be discoverable, given that you don't have too much customers and too much noise as a consequence of that. You'll have to be on Angel List, LinkedIn platforms. You'll need to write periodically, make sure that there's research papers you're releasing regularly, publicly work with academia, especially the global academia, because academia does play an important part, in the way VCs look at you. Do a competitive analysis, difficult at an early stage, but to whatever extent you can. But as you start getting closer to fundraising from a VC, this will become important. Early stage, when you're doing grants, friends and family rounds, this is tough. And like I said earlier, do a thorough research of the prospective VCs that you can go to. Make sure that they do invest regularly in your space. An opportunistic investment is not going to happen often, and it could end up being a lot of waste of time. If some analyst in a fund expresses interest, and you chase it, and you realize after some time that it's not working out. And look at the founder network that VC has, before you go in. Important also to get into corporate accelerators, because they'll get you a lot of business as well. If you can fall within a corporate accelerator, getting into relevant alumni networks, whether it's just for example IIT Bombay or IIT Chennai, those networks will help you get business as well. Simply because a lot of them are working in large global enterprises, and they'll be able to help you navigate the whole process of customer acquisition, where you fit in the roadmap, like we were saying earlier. Those cycles are long, and therefore any advantage that you can get, in hacking it is great. Kaustubh, any thoughts here?
Yeah. So, Srinivas, like some of the times we've seen that where some of these deep tech founders have maybe done their pilots and are now looking to come to us for a seed round, they are in a need for a quick check. They don't have time to wait, right? But I think the biggest challenge we've seen, at least where founders are looking to raise, is the lack of preparedness in the due diligence front. I know you said that from an early stage point of view, when you're doing R&D, it's not that much. But these people, I've realized, a lot of them are innovators. They've not done this before. So, some thoughts you have on, what are the things that these founders should keep in mind when they're approaching investors from a due diligence perspective?
So from a diligence perspective, there's a lot of basic company law compliance that is becoming more and more important today. Traditionally, a lot of issues could be fixed very, very, very easily. But now the way the regulators are looking at things, you tend to get wrapped on the knuckles a lot more. Fines can be really bad. We've seen small companies be slapped with 1 crore, 2 crore type of fines. Company law compliance is very, very important. And obviously labor compliance is important. That's violating labor laws is not something that is looked upon very kindly by anybody. Once you have an 8 or 10 member team, your ESIs, your EPFs, your minimum wage, maintaining statutory registers on labor law compliance, these two things become very important. A lot of global funds have started looking at ESG very important in a deeper way. ESG is, everything to do around governance, the social formula you follow, environment, whether what you're doing is damaging the environment, etc. So the ESG industry itself is pretty nascent in the way Indian companies tend to look at it. But, going forward, it will become more and more and more important because these are mandates that are coming from LPs, the limited partners in these funds or investing into the funds. And therefore, the VC or the fund needs to, do an ESG evaluation before they write a check. And the fourth thing around IP, no amount of caution is less when it comes to IP. It's very expensive to get patents, but patents will help your valuation significantly. Therefore, be very sure about your patent strategy, which jurisdictions you want to get patents in. Unlike trademarks with patents, once you commercialize a product, you cannot apply for a patent anywhere in the world. So you need to apply for your patents before you commercialize your products. So, make sure that you have the capital required to make your patent applications before you actually start commercializing your product. And when you talk about patents, again, the other thing is there's something called a convention application. Once you put in a convention application, you have a certain period of time post which you can make your patent application in each convention country, and most of the large global economies become convention countries. So, be very, very sure about how you're looking at patents. The other thing about patents is the wider the patent, the way you write the application also when you're going in for patents, the wider the application, the more chance that you conflict with other patents. The narrower the application, obviously it's, of lesser significance. So very important to get your patent strategy right, both in terms of which country you go into and the scope of your patent application. So if you look at it broadly, company law compliance, labor compliance, IP and ESG, these are the 4 elements that you need to look at. And the other thing around your cap table, it is not so much a compliance item, but more an economic item. But some people will put it under compliance, is to make sure that, your equity understanding between the founders and the team is very accurate. What you don't want happening is, it takes a long time to build a company. It's not something that you'll get done in 2, 3, 4 years. So a lot of the equity is sitting with the founders and the founding team. So make sure you have a good understanding of how you're going to vest your stock amongst yourself. And what happens if one of the founders or one of the founding team members wants to leave the company? What happens to the stock they hold? How much of it gets vested? How much of it is retained by them? What happens to governance post them leaving? Unless you have all important stakeholders signing shareholder agreements, VCs tend to get scared off. So it's important to have a clear, documented understanding on each of these elements and make sure that when somebody is leaving, they're leaving well, because a fight among the founders will make it difficult to raise money at a later point of time. So these are the things I'd like to highlight in terms of due diligence preparedness.
Right.
Anything you think I missed, Kaustubh, here?
No, I think you covered it all, Srinivas. I think if founders come to us with this sort of preparedness, that process is going to take a couple of weeks rather than a few months.
To close, yeah, absolutely. Absolutely. And some of these things we can help you at RuleZero. I don't want to talk too much about this because I want this session to be more focused on what the startup needs as opposed to what RuleZero can offer. We can always talk about what RuleZero can offer and how we can help. You can just reach out to us and we'll talk about that separately.
Great.
So, we are done with this session. Like I said, key things to look at is what kind of capital is available to you, at what stage you are, what kind of VCs to raise money from, what kind of due diligence preparedness you need to have when you go out to VCs. Look at grants seriously because evaluation cycles are shorter and while conditions are there, if you fit into a particular kind of grant, it helps you go a long way. Early stage, not too much capital required, therefore it's less of a problem. But a lot of capital tends to get required at a later stage. But then mainstream VCs will come in, and a lot of checks will come in at that stage. So, in conclusion, great space to be. I think with what ChatGPT has done, suddenly it's taken This sort of similar to how semiconductor financing would happen in the last century. VCs writing checks knowing that the first revenue would be 4, 5, 6 years later. So it's something which people had understood, but it was not very common. But hopefully with what ChatGPT has done, a lot of VCs will start looking at this space in greater detail, and be more ready to write checks, because the returns are phenomenal when you pull off a successful startup. Kaustubh, anything you'd like to add in conclusion?
Yeah, no, I think what I hear from you now is that it's even in this funding winter that we see, it's not all's not lost. People can really actually find great partners in seed funds and VCs and through grant capital. Great opportunity out there.
Absolutely. The funding winters, in my mind, temporary. It never lasts too long. And has never lasted too long. So it's just going to, given again what ChatGPT has done, there's going to be a whole new innovation cycle, going forward. A whole lot of other, ChatGPT was really deep tech when they started, right?
Yeah.
But no longer are. But it's going to make Indian investors look at things very, very differently. If I'm not mistaken, there was an Indian grant from a large Indian corporate into ChatGPT when they, in OpenAI, when they started. So hopefully, large Indian corporates would look at deep tech a lot more seriously and start allocating funds for it, and hopefully they'll start writing grant checks as well. But that's just hope at this stage. But it's just a matter of time, I'm sure, before it happens.
Yeah, I think that leads us really well into some of the questions that have come in from the audience. Are we okay to move on to the questions, Srinivas?
Absolutely.
Yeah. So we have a few questions. Audience, please keep on putting down your questions on the chat. So Srinivas, I'm going to start with the question from Dr. Harsh Sethi. He's worked on developing a patented solid-state nano coating for solar panels, and they have been incubated at IIT Bombay, but they are trying to understand how do they approach VCs and angel investors who are more interested in the deep tech space and who are less sort of inclined towards traditional, quote unquote, traditional spaces, and how and where they should contact them and what should be their approach.
So we made that list, right? That list is a good place to start. These are all the investors who do look at deep tech. Like both Kaustubh and I mentioned earlier, this is not an space where opportunistic investments happen. It's good and bad. It means that you have a smaller list. That's the bad part. But the good part is they will look at you seriously, because they don't get too many opportunities. So that list is a good place to start, but that list is not exhaustive. If there's anything else that we have access to, we'll send it to Dr. Harsh.
Great. Thanks, Srinivas. So the next question is from Dr. Satish. So he's asking you, Srinivas, what are your thoughts on using investment bankers versus the founders themselves front-ending the fundraise process?
So at the early stage, there are not too many bankers who operate in the first place. Bankers tend to, the good bankers are all looking at, the minimum check size of $10 to $15 million. So early stage, there are really no bankers who can help you. It has to be founder-led. And also, bankers tend to be more good when you have a business plan in place. You're able to present projections, etc., etc. Bankers are not really the guys who can help you understand. They're not really good at understanding the tech that you're developing, and therefore you will need to do the sale yourself. So this is a space where you'll have to raise money yourself.
No, absolutely. I think just not have the lack of numbers at that stage is a limitation of engaging investment bankers for sure, I think.
Absolutely.
Yeah. So the next question is from Manas. So I think this is a great question. So if he's asking if a deep tech startup has already done a DD with a third party for an initial fundraise via convertible note, will that DD report be valid for other investors or VCs if they come in for a next round in less than a year?
So it's very common for later VCs to look at earlier DD reports. At least it'll definitely take you past the first gate fairly quickly. They will look at the reports, especially if it's coming from credible agencies. And VCs will just do a top up on that typically. So let's say, I'm just taking a random example. You had a DD report as of June 30th, 2022, and you're looking at a VC today. The VC would like to understand what has happened in the last 9 months. And they will accept what is there till June, so long as it's from a credible source.
Absolutely. I think that's our approach also. It minimizes cost, time, everything.
Absolutely. And also it validates the process for you, right? I mean, you know that there's a certain amount of credibility to what is being presented to you. So it makes your job easier at the end of the day.
Exactly. Any other questions? Please feel free to drop in. So I have a question, Srinivas, here. Yeah, I think, Srinivas, you can choose to answer this question or you can maybe take it up later. But Dr. Harsh is asking, does it make sense to file a patent in the US, India, and wherever you file the patent, does that affect the valuation of the company?
It definitely affects valuation, no doubt. And second, like I mentioned, let's say on January 1st, you commercialize your product. On January 2nd, you cannot file a patent application anywhere in the world. If you commercialized it, just taking for want of a better name, in Ghana, in Africa, you cannot file a patent application in India or the US. So you have to file patent applications in every country before you commercialize a product. You can't postpone that decision. The only way out is what you call the convention application. That gives you a window when you can apply even at post-commercialization, because you put in what you call a convention application. So you have to apply in all the countries, at some point. Otherwise it does affect valuation. Simply because you don't have a patent in the US, somebody violates your patent there, you can't really say it's a patent violation.
We have another question from Nikita. How important is it to bring a lawyer or firm on board drafting or review and for reviewing of the NDAs and other critical documents, commercial documents? And at what stage should this be initiated? Because you mentioned, Srinivas, about having to sign NDAs if you are perhaps in pretty early and deep tech stages. Yeah.
We'll help you with the NDAs. Don't bother spending time or money on that. Just write to us and we'll give you good templates of NDAs. But if it's a large corporate VC, they will send you their NDAs. Stage one, read it. It's English language. And today there are tools to analyze these NDAs. But in some situations, it may become important to have a lawyer look at the NDA as well. But that should be more the exception than the rule. If you're signing 15 NDAs, you can't have a law firm look at all 15 of them. It becomes too expensive. So you just need to get the balance there between, sending your NDAs, reviewing what the other side has sent. Look at the exceptions in an NDA. That's probably the most important part. There is a definition of what the obligation is and a definition of the exception. That really is the part you need to focus on.
Absolutely. And at what stage do you think this process should be initiated, Srinivas?
I think that's, when you start sharing confidential information, right? At an early stage, you don't really need an NDA. But the moment you start sharing information about the technology you're developing at a more detailed level, if you're just sharing, this is the product I'm developing, this is the idea, doesn't really matter, because not much can be done with that kind of information. But if you're sharing any form of IP, like, algorithm, I'm just taking an example, algorithms, the way you're constructing your semiconductor chips, at that stage, you definitely need NDAs. And what is equally important is don't sign NDAs with a non-credible party. So, agreements tend to be meaningless if the counterparty wants to do fraud of some kind. So do a background check about whom you're sharing the information with, and that has to be done by you. And then look at the NDA, because NDA is ultimately, important, but no doubt it's important, but it's second to, if you ask me, whom you are sharing the information with.
Absolutely. Srinivas, we have a couple of more questions. Manas is asking, can RuleZero help in shaping the patent strategy, patentable aspects, and patent jurisdiction, and also help in the patent filing process? I know you don't do that, but I'd let you take that up. Yeah.
No, unfortunately, we don't do that. Patents require an understanding of science. While we have a engineering team, we are more an application company than a deep tech company, right? So we don't have the ability or the DNA, to be honest, to be able to help with patent strategy. Satish, of course, can. My co-founder can, but it's just one individual, and he will happy to have one or two calls here and there. But even his understanding may not be, super sophisticated.
Okay. Another very interesting question. Anytime I meet an investor, he says, "What's the valuation?" How do I figure this out early on in my journey?
Convertible notes. Don't even try to value the company. That's the best way to go forward today. And everybody understands convertible notes. Keep them convertible till you get to, an institutional VC writing a check. Sometimes an institutional VC also will put in money on a convertible note earlier. So you'll have multiple convertible notes existing, which is fine. It's manageable.
So, Srinivas, do you want to quickly run through how convertible notes are sort of different from your straight up equity, and how those could help founders a little bit?
So, when you have straight up equity, you have valuation. So I just take an example here. I'm putting in $1 million. We've agreed on a 4 million pre-money. So the investor gets 1 on 5, which is 20% of the company. That's straight equity. In a convertible note, you don't know the valuation, and you don't want to negotiate the valuation. So you simply say that my money as an investor will convert when a price round happens. A price round is a round where the valuation is fixed. So let's say I'm writing a 100K check. I get a discount of, I'm just making up examples here, 2.5% per month, subject to a minimum discount of 25% and a maximum discount of 60%. I'm just making up the numbers here, which means if I put in 100K and the Series A or the price round happens 8 months from now, I get a 20% discount, but it's below the minimum 25% base discount that we've agreed on. So I'll get a 25% discount to the Series A round or the price round. And if the Series A or price round happens much later, I get a 60% discount, which is the cap of the discount. The other thing which convertible notes usually have is an outer limit. And the price round should happen 2 years, 3 years, 4 years, whatever. In the deep tech space, obviously the time needs to be much longer. In the non-deep tech space, the time is usually 12 to 18 months, maximum 24 months. But in your space, saying price round within 24 months makes no sense, because the price round may take 3-4 years. So the advantage of the convertible note is the pricing is pegged to the price round, and it is a discount to that price round. The discount is usually healthy because the risk is too large when the check comes in. And if the main VC is getting 20% of the company, and the price and the convertible notes are, let's say, 50% of that amount, you'll probably end up giving between 13 to 15, 16% of the company for the convertible notes, with the VC taking 20%. There are some nuances in convertible notes. It's too complex to explain on a call like this. But at RuleZero, we'll be able to, with Hissa, we'll be able to help you structure a convertible notes.
Great. Thanks, Srinivas. I think Another question that is very related to this is, if you're not fixing price, then what about safe notes? Everyone's hearing about what Y Combinator is doing. So has this gained traction in India? And
So,
what's your sense?
a safe note is also a convertible note itself. It's not very different commercially speaking. So in India, we don't use the word safe note. It's very common in the US. So in India, you either use a convertible note or sometimes you use, what you call a CCPS. It's a share, but it's a preference share that gets converted like a convertible note to equity. So that it's a CCPS doesn't really matter to you. The conversion of the CCPS is postponed to the price round, like in a convertible note, and the number of equity shares that you get as an investor is almost identical to a convertible note structure.
So another question here on, again, I think we've opened a Pandora's box with convertible note, is since it's a debt and it attracts interest, what's the usual rate of interest that you've seen in India?
So the convertible notes don't usually have an interest which is payable month on month. Unless it's coming from a corporate, because company law mandates a loan from a company to be subject to minimum interest. But if it's coming from angels, friends and family, and some of the global VCs, there is usually no month-on-month interest. The interest gets factored into the conversion model typically.
Right. So another question we have here, Srinivas, is, I think we'll move on from the convertible note. Is it important to earmark an ESOP pool early on in the fundraise process, even if an investor has not asked for it?
So when you do your 100, 200K, 400K checks from angels, we've not often seen ESOP pools being put in place. ESOP pools tend to make sense when there is some kind of value to the shares. By value, I mean reasonable value. Let's say for the convertible note of 100K, the effective valuation was $2 million. I'm just making up numbers here again. The 100K will fetch you 1/20th of the company approximately, right? That's 5%. Now, if you want to make a grant to somebody, you're literally saying, I'll give you a grant worth 5K or 7K or 10K. It sounds very unattractive to an employee. So an ESOP pool, if it's only to team members, typically gets postponed. But when you have a founding team, which is beyond the founders, senior people in the company, people with a lot of experience, they will expect ESOP, and they'll expect ESOP very early on. They'll expect that commitment because these are people who are giving up a lot of, good options to join you. So they tend to ask for ESOP. And in their case, ESOP is usually constructed as a percentage of the cap table, 1%, 2%, 3%, 5%, whatever that number is. The only thing to keep in mind is to make it clear that it is dilutive, that as and when money is raised, this 5% gets diluted for whatever money is raised. Often the way these letters are worded makes it look as though it is not dilutive, and that leads to a lot of conflict. And that's unnecessary conflict. Make sure that it is clear that it's dilutive, and the actual making of the grant tends to get postponed. It's not fair from a founding team member to postpone it because it becomes very tax inefficient when you postpone it. So if you're getting founding team members, it's great to structure their holding, if required, issue them the shares early on itself because these are senior members, and do it with a construct where you can take it back if they leave. But if it's non-founding team members, may as well postpone the whole discussion itself. While there is, you will commit to them that you will issue ESOP, not wise to actually start making those allocations because you'll end up giving too much equity. Simply because there's no value at that stage in terms of, you can't value the company at all.
Absolutely. Yeah. So any other final questions anyone from the audience has? We'll give it another minute, Srinivas, if that's okay.
Absolutely.
I think we have just one final question post which we'll close, Srinivas. Bhupendra is asking, if we go through an investment banker, what are the typical terms and charges that they may put on us?
So it's anywhere from the big global investment banks can go up to 4-5%. But market share in India is anywhere from 2 to 3%.
Right. So, and that is contingent of obviously closing the round.
Absolutely contingent. It's payable only if the money is raised. It's not payable if money is not raised.
Great. There's actually one more question, Srinivas, that's come up. We'll actually keep this as the last question. If a startup allows options for a consultant, will the tax come into play after the options are converted? And is that something they should keep in mind?
Sorry, can you say that again, Kaustubh? I didn't get it.
If a startup allots options, and I think they mean ESOPs for a consultant, will there be a tax implication when these ESOPs are actually exercised?
So India doesn't allow options to be issued to consultants. Options can only be issued to employees and directors of a company or its holding a subsidiary companies. So when you want to issue options to consultants, you'll have to find another structure. And yes, there is tax which is applicable. So he will have to pay the tax on exercise. So you'll have to find some other way of issuing the options. The most common way we've seen is you just pay them the cash. They use the cash to put back into the company to buy shares. So it works almost like options. But there has to be a cash outflow and inflow, and the tax has to be absorbed by the consultant.
Right. Thank you so much. We have a few more questions.
One more question from Manash. Manash, if you can just send this to us by email. This is a more involved answer. The answer is not so straightforward on this one. So happy to have a separate conversation on that.
Yeah, so I think Pallavi's dropped in the email address, and anyone who has any other questions can drop in their questions to Pallavi. So thank you so much, Srinivas. This was a brilliant discussion. I think I learned a lot, and I'm sure all of our participants learned a lot as well. Any closing remarks from your end?
Hopefully, Deeptech will become mainstream.
Yeah.
And unfortunately, the other thing I would love to see is the volume of deep tech startups in the true sense of the term in India. A lot of the very early stage, almost like discovering molecules kind of research, is much more prevalent in the universities in the West. Hopefully, we'll see a lot of that going forward in India.
Yeah, and coming to the market, lots of innovations in the universities even here, but not being able to come to the market. So hopefully that happens.
Yeah.
Great. Thank you so much.
Hopefully there'll be 20 social alphas in India in the next 2 years.
Yeah, let's hope for it.